Welcome to the Blockcrunch podcast, the show for crypto natives. Every week, we do short but in-depth conversations with the most important builders and investors in crypto, so you can filter through what's noise and stay ahead of the markets. I'm your host, Jason Choi. Nothing on this show should be construed as financial advice, and my guests, myself, and my employer may hold positions in assets discussed on the show. Today's episode is brought to you by Perpetual Protocol, Figment, and Aave. Recently, the largest decentralized exchange in all of DeFi, Uniswap, launched their version 3. Now, version 3 is not just a small update to the existing automated market maker, which all of us DeFi users use. It is a complete revamp of the model and brings in a lot of questions about different trade-offs when it comes to capital efficiency, as well as costs and prices for users, liquidity providers, and other projects that rely on Uniswap. Now, this is one of the more nuanced topics lately, and to be honest, one of the most exciting developments in DeFi lately. And initially, I wanted to reach out to the Uniswap team to get their thoughts on this, but I thought it might be more interesting to get the objective thoughts of a power user of DeFi, who also happened to be a market maker or an algo trader in a previous life, and also a current founder in DeFi that works with a lot of decentralized exchanges. And I'm really excited to bring on Will Sheehan, who has written a lot of exciting things about DeFi, as well as built his own DeFi prime broker, which we'll talk about later. We'll also touch on a few other things, including Will's thesis for DeFi, as well as what he's building at Parsec Finance, which I personally am a big fan of. So if you want to hear more about that, make sure you stay till the very end. All right, well, Will, I've followed your writing and work for a while now, so I've always wanted to bring you on the show. So really, honestly, stoked to have you on today. So welcome to the show.
Hey, thanks, Jason. Thanks for having me.
Absolutely. Now, it's been a pretty crazy time in crypto, and we just had Coinbase go public last night, my time, and morning yours, at 100 billion valuation yesterday. So before we get started, I'm really curious, do you remember when was the first time you used Coinbase, and what made you sign up for it?
Yeah, this is actually my Bitcoin or crypto origin story involved Coinbase. I'd heard about it from a friend who was buying fake IDs with it back in the day when I was in college. And I learned about it. I wasn't really into finance at the time. But I learned about it and went on Coinbase and bought one. I then sold it at 1,000. So that was one of the worst trades I've ever made.
Sure, cool. And this is back in what, 2013-ish or?
I think it was like 2015. Yeah.
2015. Got it. And I guess what made you decide to come back to crypto more seriously after that?
Yeah, so after that, I had kind of a swirling set of interests around, I was a physics student, so physics and math, but specifically on the applied side. So I kind of got into quantitative trading and, quantitative finance, as well as just having an engineering background and doing, web development, different software projects, and I kind of didn't really want to go into the finance like TradFi world, and didn't also find like a standard SaaS tech job that interesting, and so I kind of re-stumbled upon crypto, specifically Ethereum, as I kind of was trying to figure out what to do with my life, and Ethereum was like took it like 100x for me versus Bitcoin. Just because as a technical person and as someone who was interested in kind of derivatives and in financial products, it just felt so much more expansive to me. And I think as someone who's worked with a lot of different APIs on, Web 2, the whole prospect of an open API and open financial API specifically was super compelling. And I, basically went down the rabbit hole in like spring of 2017 and haven't really thought about anything else since.
That's pretty awesome. So you have some algo trading background as well, and now you're working on something called Parsec Finance. So can you give our listeners a taste of what Parsec is and kind of how did you decide to start that?
Yeah, so my background is in trading and trading engineering. I was have been involved in DeFi since like Maker, single collateral DAI, and some of the early products. And as I was trading all of these different products on Ethereum, I didn't really have like a cohesive interface to kind of understand just my portfolio, as well as prices and what's going on, what how these different financial products are interacting with each other on one screen. And so you can kind of think of it as like an interactive brokers or a Bloomberg-like interface, but for DeFi and all the complexities that come with that.
Yeah, definitely. And I'm a huge fan of the product as well. I checked it out in the very early days, and kind of having one platform to use so many different DeFi applications and different exchanges is it's a pretty amazing experience. And I'm sure we'll get to that when we talk about your DeFi kind of prime brokerage thesis as well. But Will, there's so many things I want to cover with you because you've written a lot of very thoughtful pieces, and I always thought it's very, very illustrative to kind of learn from people with that traditional algo trading background who are also using DeFi products and are very DeFi native. And I would love to kind of just start the conversation with Uniswap, which you've written about a few times before. And you were one of the first people that voiced a very well informed opinion on Uniswap V3, which was one of the bigger developments in the industry and DeFi. So for some context for our listeners, Uniswap now generates, I think, about $1 billion dollars worth of volume almost daily, and at times it even surpassed that of Coinbase. So before I dive into V3, can you help us understand briefly kind of what V3 is and how it compares to V2?
Yeah, so I think you can kind of think about V3 as a superset of V2. So basically, V2 is this liquidity strategy where you spread your assets across the entire range of prices, so from 0 to infinity. So you'll keep buying the token as it goes to 0, or sell it as it goes to infinity. But what V3 does is it kind of splits this up into a set of bins, and you can actually discretely apply your liquidity within those bins or ranges across multiple bins. And I think the best way to think about V3 is kind of a mashup of an order book and Uniswap V2 or V1, which is just this very simple liquidity strategy. But I think it's also important to note that it's not an order book either. It's not. They haven't gone all the way in the direction of being an order book. It's really an attempt to like harmonize the benefits of both trading systems.
Yeah, actually, that's a point that I wanted to hone in on because in the article that you wrote about V3, you did mention that it's kind of like an order book, but not really. So can you help us maybe understand what are the exact differences between a traditional order book or something like a Coinbase or even like a Serum, which we've had on the show before, and something like an AMM, which is what Uniswap V1 and V2 were. So what are the key differences between how does V3 harmonize the both, and what are the key differences between a traditional order book and V3 today?
Yeah, so the key differences between just a standard AMM like a Uniswap V2 and an order book is with an order book you have these discrete price levels that you can put in individual orders on. But with V3 you can actually place orders across a range, and that is only one order. And there, so if you back up a second with V3, you can actually construct an order book if you just said that LPs can just add liquidity in each of these bins. But actually, the ability to apply liquidity across a range is something that you can't do in an order book. You couldn't go and say, okay, I want to have an order out at all times, from $90 to 110 on some asset. That doesn't actually, you can't actually do that because the order book won't let you, and your orders will keep getting filled on both sides, and you have to keep doing this maintenance if you actually want to run, the simple mean reversion strategy that kind of a lot of LPs are trying to run. And I kind of walked through this in the article, but basically the reason that I think this is important is that it allows for the more passive type of LPs to participate in a way that they don't get operationally disadvantaged by higher speed and better equipped traders. So that's one big difference is these like spread orders. The other difference that's a little bit more subtle is that with standard order books, when an order is sweeping into the book, it'll take out the orders within one price level, first in, first out. So if you get your order in first, that one will be filled as the taker comes in. But with Uniswap, this actually goes across all of the liquidity in that bin pro rata. And so this kind of has some interesting implications. But the main one is that there are going to be less games around getting placement in a certain price level. And so this, in theory, will reduce the amount of transactions required to participate in these liquidity pools, which is obviously important given the computational restraints of public blockchains.
And are there any trade-offs that come with this increased flexibility for LPs? Like, would you be increasing things like impermanent loss for LPs?
Yeah. So I made a joke about this the other day on Twitter about when you're placing like a single limit order, you're actually taking like the maximum impermanent loss because by definition, you're selling your asset immediately for the other asset. And so if the asset then keeps going up, you've taken on, in theory, impermanent loss. So this concept kind of breaks down as you go more towards an order book. And so I think it's less important in V3, but if you take that definition of IL, then it does increase it if you tighten your liquidity. But I don't think that's a bad thing. Traders want to take more risk. Like the ability to modulate your risk is good. And I don't think that we should be scared of the fact that basically V3 allows you to leverage your risk exposure across a curve.
Now, before we continue, I'd like to take a moment to share some exciting companies that made this podcast possible. I'd like to talk about our sponsor, Perpetual Protocol. If you are worried about leaving your funds on an exchange that may be hacked, but you are also tired of paying for hundreds of dollars in gas fees in DeFi, you should check out Perpetual Protocol, because they have built a fully on-chain exchange on Ethereum and xDai that charges extremely low gas fees for trading, and they allow up to 10x leverage. Now, if you're paranoid about smart contract exploits, don't worry, because Perpetual has also obtained protocol-level insurance via Nexus Mutual and Unslashed Finance to provide automatic coverage for all traders on perp.exchange. Now, today, for users outside the US, if you have an Ethereum address, you can already start using perp.exchange with no signups. So go to perp.exchange/Blockcrunch to check it out. That's perp.exchange/Blockcrunch. I'm also proud to call Figment a sponsor of the show. If you're part of any crypto project or you want to launch your own crypto project, you definitely need to check out DataHub. DataHub is Figment's newest product, and they're the fastest way for developers to launch and scale Web3 applications. You can access standard network RPCs, submit transactions, and build even faster with DataHub's unique enhanced APIs. And that's all because under the hood, DataHub is powered by Figment's best-in-class blockchain infrastructure and is already offered on networks like Cosmos, Avalanche, Near, Celo, and a lot more. And if you sign up today, you can also get a special offer of 1 million requests per day for free at datahub.figment.io. Trust me, you and your team are going to want to check this out. So head on over to datahub.figment.io or click the link in the show notes to learn more. One of my absolute favorite products in crypto is Aave. Aave is a non-custodial liquidity protocol, meaning you can earn interest on your crypto or borrow crypto assets without trusting any centralized counterparty to hold your funds. I personally have been using Aave for a long time to earn up to 12% of my USD holdings, like USDC, USDT, or even decentralized stablecoins like DAI or exchange stablecoins like Binance USD, which totally blows my bank out the water. And if you're new to crypto and worried about security, Aave has been audited by security firms 13 times in 2020 alone, and once already this year, which they disclosed fully. So I'm really excited to have a product that I love as a sponsor, so go on over to aave.com, aave.com, to check out which of the assets you'd like to borrow and lend today. To me, one of the core innovations of Uniswap is not just enabling people to trade, but democratizing market making, right? So guys like me, I'm not an algo trader or active market maker. I can just park my assets passively in a Uniswap pool, kind of 50 to 50% kind of ETH and whatever asset I want to provide liquidity for, and instantly become a liquidity provider and start earning trading fees. Now, what you mentioned about V3 sounds like it allows for more bespoke and real-time and complex LP strategies. And I'm curious whether you think that opens up the arena to professional market makers to coming into Uniswap V3 at the expense of maybe retail guys or everyday users.
Yeah, I think this is the most important question, probably around V3. I think the answer is definitely yes. It does open up the opportunity for traders with more refined opinions and specific goals to enter the game, and that does remove fees from LPs in theory. But I think actually the concept of having an AMM that is only passive LPs is a little bit flawed, and you can even see this in the existing market, because if you route through 1inch or 0x API, what they'll do is they'll ping private market makers and see if they want to take the order, versus routing it to Uniswap. And
Hmm.
so this is actually parasitic to the LPs already. And additionally, the LPs don't get any of that order if it's an advantageous order. And so I think what's interesting here is that V3 is actually in theory, combining those two parties into the same system, and will apply fees to those, pro rata, instead of the MM being able to come in and opportunistically snipe the good order flow. And so I think that's what goes back to the pro rata mix across a liquidity level. And so I think that the routing and aggregation piece of this becomes really important. And I actually said in that article that I think that Uniswap should give out Uni for routing directly, because routing is actually really important in a system like this that is really trying to be the main liquidity venue.
And so for me as a kind of non-professional algo trader, do I have to actively manage my ticks, or and just to give listeners some context, these ticks are basically the different price tiers within the V3 design. So do I have to be actively managing my liquidity and kind of moving them between different ticks in order to compete with the professional market makers? Or do you think there's still a space for passive LP strategies under V3?
I think there will be space for passive LP strategies. I think the passive LP strategies will have to get a little bit smarter. They'll have to do things around, um, you know, volatility ranges, and trying to stay a little bit tighter, and increasing the risk to LPs a bit to get enough fees to make it worthwhile. But I think they'll definitely be able to compete, because the other important thing is that with the efficiency that comes with this new AMM, will come more volume, and so more fees, and then more volume and more fees, and it becomes a self, you know, a positive feedback loop that will really help uh, LPs. Even if you're getting a very low percentage of fees, it'll be meaningful at high volume.
And this also kind of reminds me of a critique that some listeners had for a project like Bancor, which uses a slightly more complex model relative to a vanilla AMM, which is that gas costs will be incredibly high. So, given that, say I put in an order into Uniswap as a trader, and my order crosses multiple ticks, so I will have to be hopping between multiple ticks. Does that incur a lot more gas costs than something like V2, which is much simpler?
It is slightly more gas. My understanding is that's about 15K gas per tick that you cross. Depends on the pair a little bit, how many ticks you'll cross. Usually, only large orders will be doing that meaningfully, but it's also a fairly low gas amount. I don't think that the gas effects will be that different for traders. I think for LPs, if you're managing an LP position, they'll obviously be substantial. But that comes with the territory of being more active.
Got it. And on that note, what do you think are the biggest trade-offs, right? With Uniswap V3, you get all of this efficiency, all of this capital efficiency, which hopefully generates more volumes. But what are the biggest things that it might have given up in that process?
I think the big one is simplicity. I think that never underestimate the power of a simple system in DeFi. I think the type of retail traders that are often participating want simple systems that they can kind of set it and forget it. And I think you see this with Uniswap and things like Yearn. Uh, simple systems, even if they're less efficient, often win, because people don't have to understand them. They don't have to, read a white paper to use them. And I think that's the big risk here, is that, the contracts are probably 5 to 10 times more complicated, and integrations won't be as fast. It's not as seamless to spin up a yield farm that where a pool two where you put in LP tokens, and give the token out to LPs. And so things like that are less seamless. And I think it's, a lot of Uniswap volume is attributable to that simplicity. So I think that's the big risk in my mind. And the other risk is just that, even though they're trying to harmonize active LPs and passive LPs, private market makers still try and snipe order flow from aggregators. And I think that's something that, will probably play out over a longer time frame. But I think that's a risk.
God, and what I thought was really, really interesting is that before the launch of V3, you wrote this post called Citadel's Sharp as Uniswap's Opportunity. And in it, you mentioned that instead of making AMMs more and more like order books by giving the makers or the liquidity providers optionality, they should lean into this strength and severely constrain the makers. So it sounds like Uniswap V3 might actually be leaning away from that and giving makers a lot more optionality at the expense of simplicity, as you just said. Do you think that kind of compromises on Uniswap's original vision? And how has your view on Uniswap changed ever since they announced V3?
Yeah, I think V3 is the first thing that has really made me challenge that thesis. I think it sounds really good to say that basically, you know, passive LPs can basically, the idea there is that passive LPs can accept a return profile that is a lot lower return than a sophisticated market maker like Citadel in traditional markets, just because they aren't doing any maintenance and they don't have LPs, they don't have, they're not running funds. They're just trying to make some yield on their assets. And there are even ways that Uniswap V2 is not perfectly conducive for passive LPing. There are ways that LPs can kind of sandwich trades and pull out their liquidity and optimistically add it back in at certain moments. So there are ways that you could constrain it even more by adding, withdrawal windows and things like that. But I think the issue that I've kind of alluded to already with that thesis is really aggregation. And aggregators will try and get the best price possible for traders. And aggregators are going to continue to make deals with market makers who want that flow, similar to what Robinhood's doing and has been doing with payment for order flow. It's pretty similar, and I don't really see a world where that doesn't exist. And I think that is a challenge for kind of more passive AMMs.
So you're saying that currently, if I'm using 1inch, some of my orders, so 1inch would actually go to private market makers first to get a quote before trying to fill on Uniswap. And you think that would also still happen in V3, or you think that would be lesser in V3?
I think the hope for Uniswap would be that it's lesser. And yeah, it does happen. It primarily happens on kind of more liquid pairs like ETH and stuff like that. And maybe that's what happens. Maybe just more liquid pairs, have that kind of AMM flow, private market maker flow, and the longer tail assets continue to flourish on AMMs. But I think in an ideal world, from Uniswap's perspective, they would prefer that it goes all directly to the main capital pool.
I always thought that is such a underexplored area in DeFi because when you talk about market makers in crypto, people immediately think of folks like Amber or Alameda, like the large desks that are market making on centralized exchanges. But when you speak to these guys, they usually say they actually don't do any type of market making on DeFi because the volumes are so low and the gas are so high or whatever. So who are these market makers in DeFi? Are these individuals or like smaller desks? And how can people kind of find out more about these guys?
Yeah, I mean, there are some like more established people that are doing this. It's completely permissionless still. A lot of them use the 0x RFQ system, which provides really good prices from their own desk and some from others. And from the aggregator's perspective, they're giving a better price, and from the trader's perspective, there's no reason not to do it. And I think the reality is that traders don't care where their volume is routing through, unless there's some sort of token, you know, token yield that you get from doing that.
Definitely. And another trade-off that I think we should touch on is that for Uniswap V2, obviously all of the LP positions will be tokenized in an LP token. So the token is fungible. So just to give listeners an example, if I provide into, say, a ETH USDC pool, I provide 50% ETH and 50% USDC pool, USDC into a Uniswap pool, I basically get a LP token in return that is redeemable for my share of that pool. And what a lot of projects have done back in DeFi summer is use this LP token as a almost proof that a user has provided liquidity for a specific coin, and they reward holders of that LP token with their own incentives. So there are a lot of things that you can play around with these LP tokens. Now it sounds like in V3 this might change and become less fungible. So can you talk about that? And I'm curious what you think about that.
Yeah, so I do think there's a big change. I what I expect to see happen here is that kind of these meta systems, like something like Yearn or kind of X token, that they create their own token wrappers of their positions and their position vaults to try and get some of that fungibility back on the LP side. It's substantially more complicated, but I think that's the hope, is that some service providers come up that will allow users to have an actual token that then they can maybe draw a stable coin against and things like that, because that's obviously a huge use case, and most of what's happening with Uniswap V2. And there's kind of this new wave of lending protocols taking LP tokens as collateral, and I think that's something that we definitely want to see happen with V3 as well. But it will definitely require some infrastructure.
Yeah, and just to clarify, what exactly is the change in V3 when it comes to LP tokens?
Yeah, so I mean, if you think about it, you can't just have one token that's the LPs, because you can have all these different positions, and every different position has kind of a different time that they entered the pool, and is mapped to a different account address. And so these are all individual positions, kind of similar to how you'd have a futures position that's just yours. You can't then go and like trade your futures position. You could, but it would have to be like peer to peer. And so it's a similar thing happening here. And basically, there's no way to do this individual binned concentrated liquidity without breaking that fungibility of the LP token.
Definitely. Now, I think we've covered a lot of things related to V3 in terms of the capital efficiency they can gain, and in terms of the involvement of other participants who may not be as involved with Uniswap today, so professional market makers. And we also talk about some of the trade-offs, so things like fungibility regarding the LP tokens, potentially increased gas costs, and maybe retail guys will lose out to more sophisticated LPs, so some of the trade-offs there. But you wrote this post that I think synthesizes a lot of your views here. So I'd like to kind of wrap up this part of our conversation by touching on that post. And you mentioned that in that post that you think Uniswap V3 is the DEX to rule them all. So I'm very curious, where that thesis came from, and whether it's first of all, kind of how much conviction you have around that thesis, and second of all, do you see any space for other AMM competitors should Uniswap V3 really take off?
Yeah, so I mean, to be clear, the title there is really, I think, meant to symbolize what the Uniswap team is attempting here.
So
I
not your personal thesis.
So yeah, I'm not going to say with 100% conviction that it's going to win. I do think there's a non-trivial chance that could get greater than call it 75% of DEX liquidity and DEX volume. But yeah, I think my main hesitations on applying a higher probability would be around basically the execution risk on whatever platforms it's deployed on, as well as just the ultimate question of limit order book versus AMMs, and is there anything there? I tend to think that there is, and that this is an emergent effect of trading on public blockchains that are resource constrained. Regardless of whatever high speed chain that finance ends up happening on, there are going to be resource constraints to that, because it's a distributed network, and so there are advantages to AMMs on that front. But I think there's also a chance that limit order books win out. So I definitely wouldn't apply a super high probability, but it's substantial, and I think it's an incredibly ambitious project from a team that was really already leading. And so yeah, I mean, I think it's cool to see teams like that are already have a $30 billion protocol, then going out and trying to completely disrupt themselves.
Yeah, that's a great point. And I think that also brings us to a thesis that you had that I'm very interested to discuss, which is this thesis around DeFi prime brokerages. And before we kind of dive into that, maybe you could explain what that means and where that thesis came from.
Yeah, so this is something I wrote last summer, and basically the origin of me thinking about this topic was, as DeFi protocols kind of start to expand and start to kind of solidify in the ecosystem, protocols like Synthetics and Aave and Compound and Maker and all these different lending and kind of credit protocols. I think the obvious question is where do they go next? And do they just build services on top that kind of end up becoming something like a prime brokerage, where it's this full service, basically account where you can get whatever risk you want, and that system kind of hedges itself out for you. And this is kind of what in TradFi, what some of the big banks and dealers do. And they're super powerful because they let you take on really concentrated risk, and access to really bespoke derivatives. And I was kind of thinking about who ends up being that for DeFi, and does this like kind of vertical integration on the protocol level make sense? And kind of the conclusion I came to was that I think ideally it's not vertically integrated, and you have horizontal services that kind of specialize in lending and options clearing and interest rate swaps, and you have all these different interoperable protocols that then get kind of aggregated by basically risk-bearing entities that kind of become the DeFi prime broker, where they aren't actually the protocols, but they set up basically risk parameters around letting users access these protocols. And ideally there are multiple of these, because I think my worry with the vertical integration is that then you kind of reinvent traditional finance, because there's all this like stacked risk, as you can see with Archegos last week. And I think it's really important to stay away from that. And I also think there are benefits huge benefits to protocols really honing their craft and really figuring out how to do one thing really perfectly well.
That's such an interesting point, because I mean the first wave of DeFi is really characterized by projects that do one thing very, very well, right? So Aave just does lending, Maker just does I guess lending and the stablecoin, and then Synthetics only does derivatives trading, and they really rely on composability with other projects to really grow their user base. Now at the same time, I think around the time that your blog post came out, we started seeing projects that are really playing into this vertical integration thesis. So one of the projects, Alpha Finance, they did a levered yield farming product, and they're building a perpetual swap trading product, and then an options product. And then for 1inch, I think they're considering building a lending product besides the aggregator, and obviously they built their own AMM as well. So I guess where do you see why do you think projects are starting to think about this? Are they trying to compete for more collateral and figure that they need to offer more products to do that, or is that just a natural progression for where all projects are headed?
Yeah, I mean, I think it's a natural progression of where things are in the ecosystem right now. There are a lot of really competent teams that are kind of pushing the envelope and adding new functionality. I think that's probably a medium term thing. I think long term though, with these systems, they're going to basically have really stiff competition on the capital efficiency and fee levels. And I think that basically it's going to be very hard to have one of these systems, have one of these systems win in this permissionless environment where, projects like, dashboards like Parsec and Zapper and stuff, they can choose whatever's best to work with and to let users interact with. And really, it's going to take a lot to figure out how to do any one of these financial products. I think we've seen teams execute on lending and spot trading, to a certain extent, but that's really it. And we haven't actually, seen a successful DeFi options protocol. We haven't seen a successful DeFi futures protocol quite yet. Maybe soon on that one. These are really hard things to do on open APIs, and I think it's going to require teams really, really going deep on one financial product. But I think it also makes sense that they're spraying around a little bit and seeing what works. And I think I could totally be wrong here as well.
Yeah, and one thing that I think ties this back to our previous discussion on Uniswap V3 is that right now, my simplistic way of thinking about this DeFi prime brokerage thesis is that all these projects are competing for collateral. They're trying to lock up as much collateral as possible because once you have user funds, you can then rehypothecate them, maybe by using LP tokens or whatever, into other use cases. You can maybe put them as margin for perpetual. Maybe you can even put them in an insurance fund. Now, if Uniswap V3's model is the future of AMMs, their model will inherently be more capital efficient than current AMMs, so they will require less collateral. Do you think in the early days that will actually put Uniswap at a disadvantage should they go after this DeFi prime brokerage thesis because they may end up owning less collateral than they could have?
Yeah, I think probably in the existing market with the existing set of market participants, TVL is definitely something that people care about. But I think long term, really, what you want as a protocol or as a financial product is you want to allow users and traders to take the exact amount of risk they want in the most efficient way possible without any gotchas. And that really is not conducive to pumping your TVL. And so I think teams will have to just deal with that fact ultimately. That TVL, I mean, it depends a little bit on how on the financial product for sure, but that's not really the goal. You want to create the best possible thing for users to trade or use, and really, like it's kind of ironic because some high TVL projects are really capital inefficient, and that's why their TVL is really high. And that's kind of the inverse of the actual feedback loop you want.
That's really interesting. And I thought this is a great way to pivot into talking about Parsec as well. I know you touched briefly on what Parsec is, but can you kind of illustrate it to us? How did you decide to start Parsec, and what can users do on it today?
Yeah, so like I said, I was kind of trading around my own account on DeFi a while ago, and it really started as building it for myself, and it was something that I really wanted as a way of kind of as anyone knows that's in DeFi, you kind of have 35, 40 tabs open at any given time, kind of traversing what's going on, and really the goal is to kind of try and remove as many of those tabs as possible so that you can do as much on one screen as possible in a super customizable interface that is built to scale with DeFi as DeFi gets, crazier and more complex. And as we ultimately, eclipse all of the crazy financial products that traditional finance has, and go beyond. And I think, really what you can do with it today is you can get really in-depth analytics on spot trading and spot lending, as well as some of the early DeFi derivatives protocols, as well as chain data, contract data, and all in one super customizable screen. And so it's primarily, an analytics platform as well as a trading platform. And I think over time, there will be more functionality on the actual execution side. You'll be able to do things like lending and some of these like more prime brokerage type things. But really, we're starting out primarily with analytics, and kind of keeping up with the space as it grows.
Yeah, definitely. And since I guess would you consider Parsec as an aggregator of sorts as well?
Yeah, I definitely would. It's really about captivating a certain type of user, which is kind of a more in the trenches prosumer user, that's really trading their funds around and really wants to know what's going on. It's really a way of, I think the best way to think about the product is it's like kind of the beating heart of DeFi. It's really just a way to see what is going on. It's incredibly hard to know what's going on in DeFi. There's no kind of like good place to do that. And I think Parsec has come a long way in doing that already. And you can kind of see market data streaming in live, and try to update the mosaic of the market in your mind as you try and participate.
Yeah, and there's definitely a little bit of a aggregation theory going on here. So I'm curious whether you think there will be maybe one or two massive prime brokerages, or when DeFi reaches maturity, are you going to see a lot of parsecs that are specializing in different areas of DeFi?
I think that there are going to be lots of, I shouldn't say lots. I think there are probably going to be, um, 10 to 20 really high quality front ends. And I'm obviously partial to this theory of how everything plays out. I think that protocols don't have the user; they have the user's funds, but they don't actually have the user. And front ends have a connection with the user base, their user base, that protocols don't really have on the same level. Some of the early protocols certainly do, but I think over time, protocols are just going to launch and they're not even going to have a front end. They're just going to integrate with Parsec and the other 10 really good front ends. They kind of are customized for certain types of users. Like we have kind of more pro traders, and then you have interfaces like Zapper, which are kind of more retail focused and give you a really good rundown of your portfolio. And we're even seeing this like Liquidity launch last week, and they don't even have a front end. And I don't really think that's a bad choice. Might be a little bit early, but over time, to my point earlier, teams are really going to optimize how good the financial product is, and then let other teams like us handle, how are we going to get data on this protocol? How are we going to let people use it? How are we going to show their portfolio and things like that?
Yeah, that's definitely an exciting vision, and I do think a lot of focus in the space is given to protocols, but not enough to the aggregators and the front end level, which is the level that owns the users. So I'm really, really excited to see how this plays out. Well, Will, it's been such a pleasure to bring you on. I know we went through a lot of different things, Uniswap V3, DeFi prime brokerages, Parsec, and I know you're working on a lot of things. And honestly, your blog is one of the best that I followed, and I think it's so undershared. So for people who want to follow your writing and follow your work in general, and also check out Parsec, can you give us a few areas, a few resources that they can tap into?
Yeah, so the actual site is app.parsec.finance. If you want to look at the research, it's on research.parsec.finance. If you want to follow us, Twitter is the best place. The Twitter handle is parsec_finance, and my Twitter is Wilberforce _ at the end. You can get the straight Wilberforce handle.
Awesome. I will include that in the show notes below. Well, thank you so much for coming on the show, Will. This has been a pleasure.
Yeah, thanks, Jason.